Okay, welcome everybody to ERA Live. Thanks for joining us today. Our presenter today is Dennis Reed, Senior Analyst with Edgewater Research, who is here to give a mid-year economic update for the electronics components market. Before we get started, audience members, please be sure that your devices are muted. If you would like to ask a question, please type them in the chat box and we'll try to get to your questions as time allows. This session is being recorded. We will post the recording on our website and our YouTube channel within 24 hours. Walter Tobin, ERA's CEO, will now introduce Dennis. So Walter,
Good. Thanks,
take it away.
Claire. Dennis really needs no introduction. He really is Nostradamus and helps guide us through the different ups and downs of the economy. He's a good friend of ERA's, one of our recognized resources. And as always, we put him on quarterly to sort of give us an update on the economy, what to look for, what are some of the road signs that we should look at. So, and he's just moved from Massachusetts to Ohio, so I'm very upset with him. But without further ado, I'm going to introduce Mr. Dennis Reed from the lovely state of Ohio. Dennis?
Thank you very much, Walter, and greetings from Cleveland, Ohio. I wish they gave me an office with a better view, but such is life. Thank you guys for joining us today. For those at the national conference in Austin back in February, the format will look actually the same in the information that we cover today. But more importantly, we're a good 6 months, I should say, full of data in the 7th month. I think just completed and went out last week. And with the move, unfortunately, couldn't spin the slides. So to start, okay, let's not have technical issues. To start, just some reminders for everybody on the website. And when you look at the data, what I will first tell everybody is this data is very, very good, very, very accurate, and to my knowledge, the only data of this caliber that's available in the marketplace. And that is because of you, the membership of ERA. The more people that participate, the better the data becomes, the more accurate it becomes. So just some quick kind of housekeeping reminders. The survey comes out first of the month. You'll see 2 additional reminders. Everything is published behind the quote unquote paywall on the ERA website. So this is your data for your use. And then is delivered by the no reply at mail, et cetera, et cetera, et cetera. So please check your spam box. Feel free to reach out to myself if you're not getting it or somebody at your organization's not getting it, myself or Joe Cavello. We'll make sure that we get your participation and logged in and everything working on the system. Again, this is what the email will look like. So this is not a phishing expedition. This is real. We are branded with Edgewater and then ERA. The reason for everybody, so you know why it's through an Edgewater portal, is it frankly helps us with demographic information and stuff the first time that you fill it out. Once you do that first survey, which I'll admit can be a little bit more cumbersome, you will not have to update that information going forward. With that demographic information, when I do stuff at the local chapter level, the number one question I get, do you have chapter level information for me? And the answer is we have the capability. We don't have the participation right now to do it. I cannot put chapter level info if it is one organization in that region putting out. It's unfair to that organization. It's also not statistically significant. This is statistically significant at a national level. It captures roughly anywhere between $6 and $8 billion in annual sales. So this is real data. But if you want chapter level data, all chapter level presidents, please lean in and drive this to the members at the local chapter. So enough of the lecturing, a little bit of a background for those who don't know who we are at Edgewater. We're an independent research company specializing in technology, internet, and then the consumer e-commerce space. We work with many of the largest money managers in the world, so think hedge funds, mutual funds, private equity, pensions, etc. We provide them and our industry customers critical business insights through what we call our fundamental research process. And our research dates back well over 2 decades. On our hard technology team, I think at this stage we're north of 70 years experience. So, you know, long way of saying we've seen a few things and we've seen a few different cycles. And then why do our customers use us? We're deeply connected in the industry, as I mentioned, from a fundamental research process. I spend my days, weeks, months engaging with individuals like yourselves from the rep, distributor, EMS, component vendor, end customer, et cetera, trying to take a holistic view of the supply chain. We are a resource for the investment community, both public and private. Yes, that helps us keep the lights on and these great views we have in my office, but also it provides insights into the projects that you guys are all working on. These are the people funding them. So we have insight in what's going on from the actual business conditions, along with also from the investment dollars driving them. Then we, as I mentioned, we are a critical partner for our industry customers, working with multiple functional areas, helping them to shape their strategies to capitalize on the market conditions. A little bit about my background. Won't go into it too much, but I've been at it for a while. So I'll leave it at that. My contact info is here. I will get this to Claire, Walter, the team, to go on the website, to be distributed, et cetera. So I'll get the PDF version so everybody has my contact info. So enough of the background, what you're all here for. Believe it or not, I promise we are actually in a recovery. And who knows, we might go to the moon. Why do I say that? Let's start by looking at our data with the ERA. When we started this in June of 2023, it was a pretty ugly time in the industry, as everybody knows. We had the better part of a year and a half of consistently down monthly sales through until really January of this year. For those of you at National, if you recall, my initial presentation was actually going to end with the December data. The January data came out about a week before the conference. When we saw it turn, we flipped it and respun the deck because it was the first positive month in 20 or so months of doing it. As you roll it forward through the May results, we've had 5 straight months of year-over-year sales growth across the membership, of which May showing the strongest month at around 8% year-over-year growth. What's driving this? So we'll talk about it when we get into the end market slides, when we bring some of the Edgewater data in. But for those in the questions back in Austin in late February, how do you call a bottom with a month's worth of data? I feel really comfortable calling a bottom then, and I feel even more comfortable calling a bottom now with 5 straight months of data. Yes, there are tariffs, there are geopolitical disruptions, et cetera, et cetera, et cetera. If you look at just recent history, and I'm just going to say in the last 26 years, we had the rise of the internet, Y2K, the subsequent fallout, the rise of the smartphone, the rise of the cell phone, the rise of the notebook, the global financial crisis, the data center build out, COVID shortage, COVID downturn. And what has reigned supreme through all of that is cyclicality. We are in the early innings of a cyclical recovery, and I feel very comfortable saying that right now. So as we look up what has made up that change or that inflection starting in January, most encouragingly is it's actually being driven by volumes, not just price, which to us is very encouraging as you look to a relatively benign pricing environment throughout the downturn, which I would be the first to say is very much surprising, but we've had a relatively benign pricing environment through the downturn. We've had a relatively benign pricing environment as the markets have turned. But what we are seeing is a recovery in overall shipments, which we would ascribe to at Edgewater is predominantly or entirely being driven to distribution inventory levels becoming cleaner, customer inventory levels cleaner, and dare I say, where we sit now in the middle of July, in some cases actually lean or too lean. And we'll have some ERA data with that in future slides. How sustainable is it? So this is showing, the bookings environment again from our data here with the membership. We have seen 9 straight months of year-over-year bookings growth. And again, when we look at it back in, the January, February, we saw a nice pop getting close to the high single, almost 10% range. But now we're 9 months in. For those concerns around Liberation Day and the tariffs, as you look at the May results, slight moderation for sure. But again, bookings are at the second highest level that they've been in the history of the survey. So I point that out because we are firmly in the camp that there is always external influences, factors, geopolitical events, etc. But what reigns supreme ultimately is the cyclicality. And where we are as an industry is pointing to the early innings of a cyclical recovery right now. As we move on, I marked that January was the first book to bill that was positive of 1.02. If you look, it has continued. We've seen our average sales growth. We've seen bookings continue to remain above the parity line, and our book to bill has remained firmly entrenched above 1 since the start of the year. So now again, we're looking at 5 months of positive book to bills. I'll be the first to admit a book to bill of just above 1 isn't in an operating environment where customers are going to load 12 months of orders, etc., into the book. But what this is this is very, very consistent of what you see in the early innings of a recovery. What you see at this point is customers are hesitant to place backlog. The only time that candidly they will place backlog on our supplier base and our distributors are when lead times go to 20 plus 26 weeks. So we are in an environment where you start the quarter or you start the year and you probably have to do 55% turns to hit whatever your number is from a general standpoint. That is normal. The environment that we lived in the previous upturn was not normal, where you walked into the first of the year, you were fully booked for 1, 2, 3 years in some cases, and the only governor on your sales growth was either A, how much you could mix up, B, how much price you could take, or C, what incremental capacity you could bring online. Those days are gone. What we are now is into the new normal, which is the old normal, which is just normal. We are in a normal, healthy, early innings of a recovery market across the industry. So with that, I'm going to pause a little bit and shift to our good friends at the WSTS, and I'll apologize. Lot of data in here, but want to just highlight a couple of things here from our good friends of the WSTS. For this year, the WSTS is calling for semiconductors an 11% growth number. For the first time in the last 5 years, I actually don't think I can argue with them. I think the 11% number is probably spot on. We'll highlight our number at the end of this. I think the X memory number along 11% is also spot on. Their X memory, X logic number of flat, I'd be the first to say I think is a little bit on the light side. So, we're splitting hairs there. I would tell you we're more optimistic than the WSTS. For those of you that have listened to a number of my presentations, I think you'd be surprised for the second time ever with the ERA audience. I actually get the privilege of not being the Grim Reaper, which is kind of nice. But again, we think we're in an environment where we saw all the signs of a cyclical bottom here in the second quarter. We're seeing suppliers deliver at lead times or some case outside of lead times. We are seeing customers ordering on a shorter than lead time with increased near record number level of escalations. Again, all of these that are signs that inventory is cleaner. And again, I think we could turn the page on the downturn, which is very nice to say as we're entering the second half of the year, started 20 days into the second half of the year. Just to summarize, I think a great chart in the ERA kind of heat map of end markets. I won't go through every single end market here, but some highlights. Aerospace remains strong. It's been one of the stronger ones throughout the history of the survey. The military markets are strong. I think it is interesting to point out that when you look at the last results for the automotive market, it was noted as the weakest one. What I would tell you is the auto markets have been very volatile. We do know, and we love all of our good friends in Detroit, but we do know the automotive industry in general is not the best procurers of electronic components. They're also in the crosshairs between the tariff moves, in particular with Mexico and China. So there's been a lot of volatility, a lot of inventory cleaning. I'll talk about demand, et cetera, from an end demand standpoint going to the next slide. But again, I think that's really when you look at the big goose egg for automotive, for participants showing strength, that's how I would explain that away for those on the call. So shifting from the ERA data to the Edgewater data, looking at automotive production for 2025 and actually an early peek into next year as well, we have production flat for this year. Roughly call it 87.5 million units globally. The mix is interesting. China was strong through the first half of the year. We'll talk about end demand here in the US, but that was strong early in the year. I think it's fair to say the trend through 6 months was above this. But again, as we've seen some of the puts and takes with tariffs, it's a good news, bad news scenario. The second half outlook is probably moderated from a production and demand standpoint, but the full year is still intact. So it's really just a calendar shift from the first half of the year to the second half of the year. But all in all, a flat production with us forecasting, again, call it 2 to 3% growth, getting 88, 89 million units next year. This is a healthy automotive market. For the questions that come up on EVs and what's going to happen with EVs, and I know several years ago I did a very, very positive presentation at National in the EV marketplace. What I would tell you with EVs is I think there's a greater dichotomy right now than ever between the East and the West. In the West, unfortunately, we've tried to mandate our way to success versus competing on economic reality. When you look, even though the leading EV OEM has its own geopolitical or political challenges with it, they still dominate the market share here. For your traditional internal combustion engine OEMs, candidly, their products are just not quite up to snuff. The battery charge, usability, et cetera. So I think we're past in the West. In an environment in the EV market where the early adopters have adopted. For the next leg of growth, if you go back to that presentation 3-4 years ago, we're at that conundrum where the infrastructure is not in place to drive further adoption. The use case is not in place for further adoption. And without greater investments and/or fixes, I would say, on the infrastructure, I think we'll be more in a moderate growth environment here in the West for EVs. China, on the other hand, the innovation there for EVs is extremely high. The innovation for charging is extremely high. And then you also have the government kicker that continues to drive adoption across the marketplace there. As we shift from production to end demand here in the West, very similar to what I touched on with the production standpoint. Good news, bad news scenario. When we went back to the start of the year, Last year, the SAR, or seasonally adjusted annual rate, meaning the monthly number the government pulls together that ultimately tallies into the total number of vehicles sold. Last year ended up better than expected at 16.3 million vehicles for the year here in the US. January 1, our forecast was for a flat to slightly down, so call it 16 to 16.3. When you run forward through this year, the month of April had a number that was 17 and a half or so, I think, or sorry, March was 17 and a half, April was 18 and a half, May was also strong. So we were well above trend in those months. That's the good news. The also good news is that full year forecast remains the same. The bad news is that means sales or end sales will likely moderate as the year goes forward. As we all know, when you need a car, it's not like you buy one every month. So if you bought one, you should be good for a few years, unless you've got a couple of places in the Cape that you need a few other nice Jeeps. But outside of that, there was definitely some pull forward from an end demand standpoint, but demand is still hanging in there for the year, which is important. And again, in a flattish, call it, environment with more moderate growth in the EV marketplace, this works ultimately for our business. Gone are the days where you have 25% growth in your automotive business unless you catch the right program in your individual business. More likely, we're back in an environment which is, I would deem, healthy, probably in that, call it 7 to 10% CAGR over time, as we look at continued migration to hybrids, electrification of the internal combustion engine, with a smaller growing but still a growing EV presence. As we move out of automotive and we look in the industrial market here, honestly, not a ton to talk about. As you can see, the year-over-year growth has really been effectively flattish, dating back to about January-ish, or call it, early 1Q 2023. And for those of you that pay attention to PMIs globally, I think this coincides with that. By and large, PMIs globally have been either in the 49 to 50 range. So again, in that slight contraction to slight growth, which leads to production here in the US, or total manufacturing production here in the US, let's call it flattish, plus or minus. That by no means our business should be flat. When you think of automation, when you think of robotics, when you think of markets like that, more energy efficient systems, that is where we think the industrial market continues to return to trend. You're seeing early innings of that right now, as inventory starting to clear, where you're back in that environment where, again, it should be a mid-single digit grower, or mid to high single digit grower over time. That's what our outlook for the CAGR is. And then again, where does that fall within your business? It depends on your market and your customer base, and candidly, their inventory positions where they sit in a given month. But again, the industrial market is still healthy. It still works in a, call it around 50 PMI number. This is consistent with, a relatively benign low growth real GDP number. And that's ultimately kind of the environment that we're operating in right now. As we move from the industrial market into the military market, not a ton to talk about here. I think the story is by and large similar. Unfortunately, we live in a less safe world than we've been in recent years. So when we go through that and you think about that over time, the defense spend or production has been a long-term secular growth. More importantly for our business is what the money is being spent on, right? So we are seeing what I would coin the continued digitalization of our armed service. Yes, there are conflicts all over the world, but really the Department of Defense budgets are predominantly being focused on, and I would argue what most of you guys are working on that serve this market, We're working on hypersonic missiles. We're working on cyber warfare. We're working on drones, autonomous vehicles, satellites, etc., right? That trend will not go away regardless of if one conflict heats up or cools down. That trend continues, and ultimately we think will continue going forward. I'll touch on a couple of markets I know not as important here. The PC market, really not a ton, to say it's an overall kind of muted market here. We think it's we're at the point in this, call it very low single digit growth where we're starting to grow ourselves back to what we think the real installed base or the real perpetual number is, which is 275 million. So again, we've kind of crawled back from the downturn. We've digested that pull forward demand in COVID. And at the end of the day, we think the PC market, again, remains in that 275 million plus or minus, depending on whatever the refresh cycle might be during a given year. From a server standpoint, I'll touch on this one quickly. Ultimately 3 markets that drive it, so I'll hit them all very quick. The enterprise on-premise market has been depressed and remains largely muted and conservative. Again, I think when you walk backwards from that market, it is consistent with a slower macroeconomic growth. I'm sure those in the industry know you still are seeing SG&A rationalizations of headcounts, etc. Unfortunately, all of that coincides with a relatively slow on-prem. It will be interesting to see. You're seeing an increased focus on people being called back into the office. We'll see how much of the shift to the cloud has stayed. So that's on-prem in a nutshell. The AI, not going to touch on that all that much. You can see that when you go back to the WSTS slides. That is the growth driver in the industry. The leading processor companies are driving growth across the semiconductor industry. There's still plenty of demand across the CFPs. There's also plenty of sovereign wealth demand, meeting various government entities building out the AI infrastructure. So that demand remains robust. What I will tell you has been a change this year has been the core data center business. That business has been relatively subdued since the AI craze has started. We have seen some life in that market, but I would give it to you with one caveat. A bulk of that life was in the first quarter and early second quarter, predominantly driven by the Chinese data center customers, which again, I think you could tie back to the current administration's more hawkish tone on China, additional trade restrictions, etc. So while you've seen, call it 8%-ish type year-on-year numbers in particular out of, your core kind of CSP cloud service provider customers, we do expect that to moderate because the Chinese customers, again, have clearly pulled forward demand to get ahead of additional restrictions from the current administration. As we move back to the ERA data, I want to talk a little bit about inventory here. And as you can see, while we saw a change in sales in the January period and, a little bit of a, quote unquote, too low inventory in the interconnect side, the overall average inventory was still viewed as too high. Semis were kind of in line to a touch too high. And then the customer inventories were all way too high. This is a great slide for everybody on the call to use. There is no other data, and we interact with a lot of the executive suites in the largest companies, and they will tell you candidly, the moment the product leaves their shelves or their distributor's shelf, they have no visibility into what customer level inventory data is. I firmly believe with I think it might be 700 members now at ERA, somewhere between 650 to 7. I don't want to cheat the organization. But with that many boots on the ground, you have the best insight into what customer level inventories are. And as you can see, starting in March and in April and into May, customer inventory levels are now lean. So again, when you go back to the overarching theme through the first, call it 20 slides or so, that is consistent with what we are seeing of a cyclical recovery. Customers have gotten lean, distributors have gotten lean, and we're starting to see the industry returning to ship back to consumption, which is very, very typical with this point in the cyclicality of the industry. As we move out of the
Hey,
year,
Dennis.
yes,
Dennis, I'm sorry. There was a question, and I think it was for 2 slides ago. Someone in the chat wanted to know, what is the red line on this graph?
this one,
Yeah,
year-over-year growth.
perfect. Okay.
No problem. Thank you. I should have cleared, all red lines are year-over-year growth, percentage year-over-year growth. So talked about what our membership is seeing from an inventory. What are the companies reporting? So for those that know, we track inventory. This is backward looking in fair defense. The 2Q financial reporting season starts in earnest, literally as we are on the call with Texas Instruments at 4:30 Eastern today. So this is looking backwards, exiting the first quarter. But it's worth noting, as you can see the days of inventory change. And again, I'll stick with days over the dollars with price mix, etc. Days of inventory from a top-down standpoint, we're down 5%, sequentially up 1% year over year. I am not worried about that 1% number because when you drive down to the year over year, it's entirely driven by the 20% growth at the OEMs. It is worth noting, if you take this slide out and you want to use it, our data sample for this does skew very heavily to the compute space. So think of your major publicly traded compute companies, also the networking guys as well. So that number is very, very heavily influenced by the AI build-outs and getting projects ready for deployment. So again, I think when you look at the turn in our data that showed inventories going down, and if you want to sanity check it here, this is data as of the end of the first quarter. We are in line as a membership in a survey result. So everybody, more that participate, the merrier. But it is good progress and kudos. And again, it's another data point that when we look out, we feel comfortable saying that we are in the early innings of a recovery here cyclically. Lead times, again, yeah, I think it's worth noting in terms of a use case. I'm not aware of a 700 member organization collecting lead time data. You guys have this at your disposal from an overall lead time, a semis lead time, a passive lead time, and an interconnect lead time. As of May, most lead times are showing between the 10 to 16 week range. What I can tell you from our research process, I would agree with that. What it is worth noting is we are seeing an increased number of suppliers delivering at or above lead times, meaning your lead time, and again, I'll take the ranges here, your supplier is quoting between a 10 and a 16-week lead time, and they're delivering in 17 weeks. What that means to us, again, customer inventory levels are lean, distributors inventory are lean. Everyone's operating their utilization rates of their factories at, call it, depending on the category, anywhere between a 60 to maybe a 70 on the high percent. So they're building work in progress inventory, guessing on historical demand trends. I have the utmost faith in all the executives in our business. However, that is an impossible way to get 100% right. This is the makeup that I would tell you. What I see right now in our work, we are kind of sleepwalking into a lead time extension, assuming demand just remains stable through the second half of the year and early next year. As we look at the pricing outlook, I would tell you, I think that aligns with it. You can see the pricing outlook for the next 6 months. It is all for price increases. I do think there's I'll use the word noise, and it's not a fair word to use that word, but it's the one that came to mind. There is expectations for pricing from tariffs being potentially passed through. That is a price increase, and that's factored into this result. What I will say is if you get more into the interconnect space, we have seen several of the tier one suppliers pass through channel level pricing, call it at Jan 1 based on metals, etc. So again, when you look back, I think by and large, we had a relatively benign pricing environment. And when you look at the pricing outlook going forward, it is inflationary, which does have the kicker of tariffs and metal and other inflationary pressures on it. So boiling all of it up, what does the membership think for the year? Pretty good. As you can see, we started with a 3% number to start. It jumped, a 3% number in December. It jumped to 9. We've moderated, and where we're at, call it 7.5, between 7 and 8% growth. This, and again, knowing the membership, which does skew geographically to the US, knowing the membership that does skew more to IP&E when I go into our forecast on the next slide, this makes sense to me. So again, we have some near-term tariff volatility, but as you can see from the membership, it's still a pretty optimistic lot. And I know Mr. Tobin would say, well, they're always optimistic because that's the nature of being a salesman. However, I think the optimism is founded based on, again, all the cyclical factors pointing to the early innings of recovery. So with that, we raised our forecasts about a week or two ago. We were 8%. We moved it to 11 overall for semis. As I mentioned, I think it's one of the first times I've been in line with our good friends at the WSTS. That, in full honesty and transparency, when you look at that move from 8% to 11, that was us tuning up our logic number from like 45 to 50% in memory, somewhere in that same realm, right? So it's I think an 8% number would have been good, an 11% number is great. When you strip those two AI-centric markets out, we did raise our forecast to 2%. So on the semi side, we are a little bit more cautious at the margin than the overall ERA membership. As I mentioned, that doesn't give me a pause because the ERA membership does skew more IP&E. But again, we're seeing the signs of clearing. We raised it a month ago. Feel pretty comfortable that if demand holds, there's probably additional upside. So again, I think the right way to think about semis this year, X logic, X memory, is call it that low, 2 to maybe 5% number. Excuse me. As you look at the IP&E side, which again, very much in line with the membership here. We were 6% previously. For this presentation, we raised it to 7 to 8%. The delta between the two, that X logic, X memory, is really how the supplier base managed their inventory around non-cancelable, etc. going in, LTSAs. The inventory and interconnect is a lot cleaner than semis, which again leaves us comfortable that they actually are going to grow above trend, especially with the AI kicker in the interconnect space. And then lastly, in the passive side, leaving it unchanged at 4 to 5%. I could tell you there are sub pockets when you look at some of the super caps and some of the markets tied to AI. We're seeing lead times go out. The one thing that keeps us maybe a little bit more cautious is the passive space has been very, very controlled through the downturn with pricing because there was limited volume and there was no point to cut price and compete against yourself. Now that we're seeing volume come back, the passive suppliers do seem to be willing to play ball for stocking deals and things like that. So again, we think, volumes will outpace these levels, but there could be some potential for some ASP erosion in the passive space. So I know I covered a lot. With that, what questions do you have?
Okay, we don't
Myself
have
off.
anything in the
Oh, here we
chat
go.
yet. Oh, there you go,
Yeah,
Walter.
I'm sorry, I couldn't get myself off of mute. I think Claire has me muted. So Dennis, a couple of people have texted me some questions. Let me just read them and see if you can help put some color on them. Uh, First of all, what there's so many metrics that people look at out there. What are the key metrics that our members should be looking at? We hear unemployment rates, consumer price index, new housing starts, interest rates. It kind of all comes at us. What do you suggest that our members sort of keep an eye on?
Yeah, great question, Walter. Yeah, I'm not gonna say all of those metrics are important because they drive the top-down view of the economy. We need a relatively healthy economy for our business to work, or even a stable one for our business to work. But I do think if you focus on the minutia of all of those data, you can get a little bit of paralysis by analysis, to borrow that cliche. So, the metrics that I would tell um, everybody in the audience to listen to, I think it's your own internal metrics that you track. And those are the ones that we're really focused on more as, maybe if you want to call it, a microeconomist versus a macroeconomist. We're ultimately focused on the health of the semiconductor markets, the IP&E markets, and the distribution markets. So what we're looking for is number of customer escalations. We're looking at inventory levels. We're looking at delivery. And again, there's a couple of different, depending on what type of business. If you're a high service distributor, it's an in-stock rate. If you're a broadline distributor, it's where your supplier base is delivering versus your stated lead time. We're looking, as I mentioned, the number of escalations, the number of pull-ins, those types of activities that ultimately will drive the turn. Because unfortunately, if you just focus on the big picture ones, I think you miss the turn in our business. And that ultimately happens, for those, I think, that have been in the business long enough. When it's good, it's never going to end. And when it's bad, it's also never going to end. Right. And so I would tell you to focus again, in stock rates, customer, supplier shipment to lead time, number of escalations from the customers. I highlighted that customer inventory chart. It's going to be really interesting, as it appears we're starting to sleepwalk into another shortage situation, to see how that reacts kind of through the cycle. But those are the areas, honestly, that we're focused on. I couldn't tell you the last time I've looked at SAR. Or I'm sorry, not SAR, housing starts. I pay attention to SAR because it's an indication of end demand. It's a real shipment number. But again, it's hard to kind of plan your business around it. I'd focus more on the micro stuff that you can control. And then again, I think when you go even as well, to, in particular, the rep universe, versus the component vendor or the component supplier or the distributor, focus on what you can control. It's the design registrations, it's all the other metrics that are built into your own individual CRM that's going to drive your business over the long term versus housing starts or CPI or things like that.
Good, thanks, Dennis. Claire, any questions on the chat?
Yeah, Bob Curtin had a question in the chat. Bob, do you want to maybe unmute yourself and ask Dennis your question?
That's an awful lot of pressure. Um, Quick question, Dennis. You said that semis were X memory and X logic. Depending on how you define logic, what's left?
It's Bob, that's a great question. I have walked through. So if you look at what's left in the semis, you've got analog, microcontrollers, sensors, discretes. That's kind of your X logic number. Um, I have attempted in that logic number to do my best to strip out the leading AI processor company to give a leading AI processor company number. They don't disclose it, which I could certainly understand from a competitive standpoint. You can't just run their data center revenues through and pull those out, because then the numbers also don't make sense with their software sales. So that's why we just strip it out to try to effectively look at, again, that analog, that micro, sensor, discrete, all of those products that are kind of non-AI, big ticket, leading data center or leading AI processor company. Because the leading AI processor company, I think their data center business is going to do something like 130 billion in revenue this year. But that's not all silicon, right? That includes networking equipment, that includes software sales. So it just gets convoluted. So that's kind of why we look at it that way, Bob, and that's what it includes.
Okay, so you include M, let's see, you can include microcontrollers, you don't
Correct.
include microprocessors.
Correct. Look, sorry to give everybody whiplash here, but it's discrete opto sensors. Basically it strips out that logic line. That's, and again, when you look at it, AI, so in October of 2022, the October 2022 quarter for the leading AI processor company. So right here, when it was $176 billion number, the leading processor company that quarter in the bottom for them did 5 billion in sales. This year, 2.5 years later, they're probably going to do 35 in that quarter.
Got it. Thank you. That was helpful.
You're welcome.
Thanks, Bob. Dennis, another question that came in is I'll wrap up two questions in one. You touched a little bit on tariffs, and also, what do you see as the impact, near and long-term impact of tariffs? And also, any color you can give us on the recent bill passed by Congress and what you see as might be the impact second half of this year and next year.
Yeah, so I'll start with, the big beautiful bill, or whatever you want to call it. Probably not a surprise to anybody in the audience. I have not read all 847 pages of it. I'm sure anybody who voted on it has also not read all 847 pages of it. But leaving my tongue in cheek on both sides of the aisle out, I think some high level brushstrokes with it. Long term, the debt that we carry as a country is arguably unsustainable, and this is surmising people that are smarter than I am in these matters. And we're adding something like $3 trillion to our debt with this bill. I don't think that's sustainable. Big chunks of it, whether it's border security and things like that, I think that depends on where you fall politically, ideology wise. So, not going to speculate on that. I think, when you look at probably near term, with the big beautiful bill, or whatever you want to call it, what does it mean for our business? Probably the most tangible one, Walter, is the sunsetting of the EV tax credit. As I mentioned when I was talking about the kind of end market outlook for auto, I do think the early adoption here in the West is very long in the tooth. For a couple of reasons. One, we don't have the charging infrastructure, and a lot of the data that I showed back at the ERA conference, I think in 22, Your fringe buyer of an EV, I think when you take away that $7,500, there was a step, I think, in the previous administration where they limited it with some bill to only households that made less than $100,000 a year, which I think that already had a negative impact because most EVs run a premium price point anyways. So you arguably need to make more than 100 grand to afford a $50,000 car. So I think that was a demand kind of headwind for the EV marketplace here in the US. When you see it go in entirety, I would take it a step further. So, I think that aspect of it will maybe be another potential headwind for future programs for EV, assuming it stays for the next 3 years and there's no other changes, et cetera. The flip side to that is, does that force the OEMs to go deeper in terms of the R&D spend to further their hybrid offerings? Probably. Does it work to drive additional fuel efficiency and investment in the internal combustion engine? Probably. Net, it's probably again, I think net is probably negative overall for our industry because there's just more content in an EV and it'll probably, further mute the demand. So I think that's the one for the recent legislation. As it relates to the tariffs, I think that's an interesting one. And there's, I think the way that we're thinking about it through maybe the second half of the year is more of a range of outcomes for the second half of the year. So with this tariff, I don't even know what you want to call it because the date keeps moving and now it's August 1st. It's obviously very, very hard for a customer to plan when they don't know the cost of their bill of materials. So it's hard for them to plan. The potential for pull-ins and/or inflationary pressures on the end customer, whether that's a B2B, B2C transaction, increases, the potential risk to even a stabilized number. So again, I think those types of scenarios broadens that range of outcomes potentially in the second half of the year to open up downside to forecasts. The flip side to it, and I think, what I had talked about through this, there's no way around how geographically diverse our industry is. So the ability for demand to just remain the same, people to wait for tariff clarity and draw down inventories even further raises the quote unquote upside risk of kind of that cyclical kind of snapback in any given point. So again, that's why, it comes down to end demand versus supply and how the tariffs impact it. So I think, when we try to level set and we talk about it across our team, it's really expanding, range of outcomes where, I'll just make up a number. Let's just say your initial forecast was the second half of the year grew 5% over the second half or the first half of this year. You could probably paint a doomsday scenario where the second half is down 5% if everything goes wrong. You could also paint an upside where it's up 10+% if it ends up only impacting the supply base. So I think it's more of just a range of outcomes. One, two, when the initial Liberation Day, and there may be some on the call that I reached out, right after Liberation Day and did like kind of one-off, let's just spitball what this means. I had several conversations with people and it really helped shape my thought. And several people that are much smarter than I am in the industry and in life that just said, we don't really care what the number is. We just want some finality to it, and then we can compete, right? We know if it's 70% or 170% at the time from China, we know what our factory network in China will cost to bring it here. We could pivot to Malaysia or Mexico. We know what our costs are there, and we can compete against our competitors based on our ability to wring productivity, how we work with our distributors to FTZ it, whatever the case may be. We can compete. But when you have a moving target, I think that's the big challenge that I have with it. And I would say my thoughts around that have evolved in the last 3 months since since the first slide board was put out at the White House podium.
Thanks, Dennis. I think the final question that I have that somebody texted me is one of the end games of the tariffs was try to move manufacturing back to the U.S. What can you give us any color on onshoring, and how is that working, and what you see is sort of happening second half of this year and maybe next year with the movement to bring manufacturing back to North America?
Yeah, it's this is one where I think my thought process, even with the tariffs, haven't evolved over the last couple of years. What I think COVID, if you go back to the COVID time period, what I think COVID had shown us is a need for a geographically diverse supply base. And there's, a couple of different, there's a whole host of different reasons going back there. And that's ultimately, Walter, when the nearshoring talks started. And, my hypothesis then was it's more than just cost in China in particular. It's since China has entered the World Trade Organization in 2004, I believe, if my memory serves me right, but call it somewhere 20, 21 years they've been in the WTO. There has been $5 trillion of foreign direct investment. That doesn't even include what China spent themselves. That has gone beyond just funding factory networks. It has funded education, it has created the workforce, etc. So, I think you take that as a level set, and then you look at, ultimately where it goes, whether it's geopolitics, whether it's pandemic concerns, whether it's being close to the supplier, whether it's a China plus one strategy, there is a need to diversify, but that need to diversify is not going to equate to we snap a finger and supplier ABC goes from 60% production in China to 60% in the US in any given time. I think those changes are going to be measured over years, if not decades. I think this gives, I think this gives some credence to that time. I think if you want to give the current administration credit, I would hope to think they're using, the early 90s in the Japanese automotive OEMs as kind of the benchmark for this, which is purely a nearshoring. Toyota, et cetera, is eating our lunch. Let's slap a 50% tariff on those vehicles, and then they created an auto infrastructure in the Southeast, right? The challenge, though, with that being in play, we had the labor, the infrastructure, et cetera, in place for the US. We don't have it for the component industry. We don't crank out enough electrical engineers. It's a scary stat that China cranks out more AI engineers a year than the rest of the world combined. So again, I think there's a lot. I think it's happening. I think there's We don't talk a lot about the CHIPS Act right now. I think the CHIPS Act was a great idea by the previous administration. I think it was too small. I think fine, you want to do tax incentives, and it's helped some of the leading guys build some massive stuff in Phoenix and Texas and everything else. To the best of and there was a great session this year by the professor from UT Austin that I attended, one of the breakouts. But what I didn't hear from him was the US government created a program where if we create an AI engineer, their student loan is erased as long as they take a job for a US based company. Maybe it's perfectionist, maybe it's a little bit protectionist, but again, I think we're missing the labor. I think we're missing the labor and the education component to really do it in earnest. So it'll be more of a slow trickle in than a tidal wave.
Sure. Well, Dennis, as always, you've given us so much to think about, so much to worry about, but you've been great as always. We're at the hour. I'm going to turn it back over to Claire to wrap it up. But thank you, Dennis. As always, you've been brilliant, and we'll look forward to seeing you in Austin.
I can't wait.
In
At the
in
new
February.
location.
Say again?
At the new location.
New location, new Hilton location, and we'll look forward to seeing you. So I'm going to turn it back over to Claire. Claire, take us home.
Okay, thanks, Walter. Thank you, Dennis, as always, for your valuable insights. Again, the monthly survey that we send out for the ERA Edgewater survey, if you'd like to be added to that, please email Natalie Zullo, our operations specialist. Her email is in the chat. It's nzullo@era.org. As a reminder, this session was recorded. It will be posted on the ERA Live section of our website and our YouTube channel within 24 hours. The next ERA Live will take place on Tuesday, August 19th at 4 o'clock Eastern. Adam Glazer, attorney at SFBBG, will present on the latest legal issues and challenges for sales reps and the greater industry as a whole. So we hope to see you there. Thanks, everyone, and have a great day.
Thanks, everybody.
Thank you.
Bye-bye.
Thanks, guys.